Though the TSP does have a certain amount of flexibility, there are annual TSP contribution limits. Once these limits are met, an employee can no longer contribute to TSP for that year. However, that does not mean an employee can no longer accumulate retirement savings. In steps the IRA. Hello, this is Brandon Christy with Retirement Benefits Institute, excited to talk about 2021. And today I want to talk about your IRAs. In particularly, we're not talking TSP. I want to change the subject a little bit to cover some areas that you need to know about outside of your federal benefits to help make sure that you build a full retirement plan. When you step into retirement, what's our goal? Our goal is that you are ready to retire and that you can answer that big question, do I have enough money to retire, that you can answer that with a yes, I'm in good shape. So today, for 2021, we want to talk about IRA contribution limits. FERS employees generally have three primary ways to build for retirement. You have your FERS pension, your Social Security, and the Thrift Savings Plan, the TSP. The last of these three, the TSP, is that government-sponsored 401k program that allows federal workers the opportunity to accumulate retirement savings. Though the TSP does have a certain amount of flexibility, there are annual TSP contribution limits. Once these limits are met, an employee can no longer contribute to TSP for that year. However, that does not mean an employee can no longer accumulate retirement savings. In steps the IRA, or individual retirement arrangements that allow federal employees to accumulate retirement savings in much the same way as the TSP, with a few significant differences. Well, the first question you should ask is, can I contribute to an IRA? When it comes to IRAs, there are both contributions and income limits. The IRA contribution limit for 2021 is an annual amount of $6,000 if you're younger than 50. Those 50 or older can contribute $7,000 annually. Note that this is the contribution limit for total IRA contributions. In other words, if younger than 50, you can contribute at most $6,000 to IRAs, whether Roth or traditional or some combination of the two. Note that the IRA contribution limits are different and significantly lower than the TSP contribution limits. For more on TSP contribution, you can see our video where we talk about those details. Here's the chart that lists both the 2021 IRA and TSP contribution limits, neither of which changed from 2020 limits. The 2021 contribution limits for the IRA under 50, $6,000, 50 and older, $7,000. For the TSP, under 50, $19,500, 50 and older, $26,000. Roth IRAs also have income limit restricting those who can contribute. If you earn more than the limit, you cannot make contributions. Roth IRA contributions are subject to contribution phase-out for higher earning individuals. According to the rules for 2021, those filing single and earning more than $140,000, or married couples filing joint who earn more than $208,000 are not able to contribute to a Roth IRA at all. The traditional IRA is like the traditional TSP. It is not in itself an investment, but is merely a tax wrapper in which investments are held. This tax wrapper means that IRA and TSP funds receive special tax treatment. The funds are tax deferred. With tax deferred money, assuming several key requirements are met, you pay no tax when you contribute to the IRA, but will pay tax when you withdraw the funds in retirement. In certain situations, this can be very beneficial, especially if you will be in a lower tax bracket in retirement. However, federal employees with a robust pension are not guaranteed to move into a lower tax bracket in retirement. Let's talk Roth IRA. It is simply another kind of tax wrapper. Roth funds are often called tax-free. However, this phrase can be a bit misleading. Tax is paid when you contribute to a Roth IRA. However, the money grows tax-free and will be tax-free when you begin to withdraw money in retirement, assuming you meet other requirements. Roth money can be accessed tax-free if you have owned the account for at least 5 years and are age 59 and a half. For those who will not be in a lower tax bracket in retirement, this can be a case for federal employees. Roth IRAs may be a beneficial option. Required minimum distributions, or RMDs, are a key difference between IRAs and Roth IRAs. Required minimum distributions are a key difference. Let's see if we can see the different lines on both sides. A traditional IRA requires you to begin taking withdrawals from your account when you are age 72. When you begin to take required minimum distributions, you will also be required to pay taxes on these distributions. Roth IRAs vary from traditional IRAs in this area. Roth IRAs are not subject to RMDs. Not being forced to withdraw money when you don't need it is a significant aspect of Roth IRAs, and one which further distinguishes the Roth IRA for federal employees from their traditional and Roth TSP. Traditional and Roth IRAs can be strategic assets for federal employees. Understanding the differences between the two and the benefits of each are essential to utilize these resources in their utmost potential. Now, this was a lot of information, a lot of choices to be made, a lot of options. I'll break it down to the 4 areas that we just talked about, right? You've got Roth TSP, traditional TSP, Roth IRA, traditional IRA. You need to make sure you understand between all 4 what you have and what you need to have a successful retirement. And to help you with that, there's analysts at Retirement Benefits Institute that are ready to help you prepare for retirement today. So call us at 877-864-1145 or click the Get Support button. We'll be glad to walk through all these details and help you build a successful path to retirement.